There's a $1.5 trillion wall of debt heading straight at the U.S. economy over the next 3 years, and almost nobody outside commercial real estate is watching it. It's not student loans, it's not credit cards, it's commercial real estate, office buildings mostly, and the people who understand what's coming are genuinely nervous. Here's the wild part. This isn't some far-off risk. The loans behind half-empty office towers in every major U.S. city are coming due right now, and they have to be refinanced at rates 2 to 3 times higher than when they were originally taken out. Before we get into it, if you want to understand where the real risks in this economy are hiding before they become headlines, hit subscribe right now, because that's exactly what this channel does. Okay, let's break down how we got here, why the next few years matter so much, and who actually gets hurt if this goes wrong. Let's start with the basics. Commercial real estate loans work differently than a regular home mortgage. Most office building loans aren't 30-year fixed loans. They're typically 5 to 10-year loans with a balloon payment at the end, meaning the borrower pays interest for years, then has to pay off or refinance the full loan when the term ends. Through most of the 2010s, that refinancing was easy. Rates were near zero, lenders happily rolled the loan over, and property values kept climbing. Then, 2 things happened at the same time. First, the Fed hiked interest rates aggressively starting in 2022, pushing borrowing costs from near zero to the highest levels in over a decade. Second, remote and hybrid work permanently changed how much office space companies actually need. Office vacancy rates in major cities climbed to levels not seen in decades. Some downtown office towers are sitting 30, 40, even 50% empty. So now imagine you own an office building and your loan is coming due. 3 years ago, refinancing meant signing similar paperwork at a similar rate. Today, it means borrowing at double or triple the old rate on a building worth significantly less because nobody wants that much office space anymore. For a lot of owners, the math simply doesn't work. And here's where it gets serious. When a building's value drops far enough and the cost of refinancing gets high enough, some owners are doing something that used to be rare. They're walking away. It's called strategic default. The owner essentially hands the keys back to the lender rather than keep pouring money into a losing asset. This isn't a hypothetical. It's already happening with major office towers in San Francisco, Los Angeles, Chicago, and other cities, where buildings have sold for a fraction of what they were worth just a few years ago, or gone back to the bank entirely. So who actually holds this risk? A huge share of commercial real estate debt isn't held by giant national banks. It's held by regional and community banks, with far less diversification than a giant like J.P. Morgan. For hundreds of regional banks, commercial real estate loans make up an enormous share of their total lending book. Concentrating that much risk in one sector, right as refinancing costs spike, is exactly the kind of setup that creates stress in the banking system. You might remember this exact type of stress from last year, when a handful of regional banks failed in a matter of days. Most of the attention went to bond losses and deposit runs, but regulators and analysts have repeatedly flagged commercial real estate exposure as one of the underlying vulnerabilities sitting quietly in the background of the regional banking sector, a slower-moving version of the same problem. And this doesn't move fast, which is exactly why it's easy to ignore. Unlike a bank run, which happens in days, a commercial real estate crisis unfolds over years as loans mature on a rolling schedule. A wave of loans came due in the past 2 years. An even bigger wave is coming due over the next 2 to 3 years. That's what people mean when they talk about the maturity wall, a mountain of loans that all need to be refinanced or paid off in a market that's fundamentally less favorable than when they were written. Here's why this matters beyond Wall Street. When regional banks take losses on commercial real estate loans, they don't just absorb it quietly. They tighten lending standards across the board, for small businesses, for local construction projects, for consumer credit. Regional and community banks are the primary lenders to small and mid-sized businesses in this country. If they pull back to protect their balance sheets, that credit tightening ripples out into local economies, hiring, and business investment, far beyond the office towers where the problem started. There's also a quieter effect on cities themselves. Struggling office buildings mean lower property tax revenue for cities that depend on commercial property taxes to fund schools and public services. Some major cities are already projecting real budget gaps tied directly to falling commercial property values. So is this heading toward a full-blown crisis or a slow, manageable unwind? Nobody knows for certain, and that's honestly the most accurate answer anyone can give you right now. Some property owners will find ways to restructure. Some buildings will get converted to apartments or other uses. Some lenders will absorb losses without major disruption. But the scale of debt coming due over the next few years is large enough that even a partial stumble could meaningfully tighten credit conditions in parts of the economy people don't usually connect to office buildings. This channel exists to cover exactly this kind of story. The slow-moving risks that don't trend on social media, but actually shape credit conditions, jobs, and your money. If that's the kind of content you want more of, hit subscribe and turn on notifications, because I'll keep digging into the parts of the financial system everyone else is ignoring, until they can't anymore.